There's some major events transpiring in the market right now behind the scenes that could spell huge upside for the market over the next 6 months. We're going to get into all the details around it and what I see happening and how you can position yourself the best to take advantage of this. But first, if you're new here, thank you for being here. I'm Austin. I'm a co-owner of cloudmusicsuite.com, and I'm a stock market investor, of course. Okay. If you're subscribed to the channel already, thank you so much. If you're not one of those 550 so people, go ahead and click that subscribe button. And as a thank you for doing that, here's a picture of both my cats, Millie and Luna. Millie's the gray one and Luna is the brown one. They thank you for subscribing. All right, so let's get into all the details around how the stock market might soar in the back half of 2023. So the June inflation numbers just came out, and we actually saw the lowest 12-month CPI numbers that we've seen since 2021. The reason this is so important is because it's getting really close to that 2% goal that the Fed has for the CPI. CPI is Consumer Price Index. Their target for this Consumer Price Index is a 2% increase on a year-over-year basis very consistently. We had runaway inflation over the last few years because of all the money printing out there and the cheap money and the zero interest rates. And then as we know, the Fed was way too late to the party, so they had to raise rates way too high, way too late, and now here we are, but they're bringing the CPI, that Consumer Price Index, way down closer to their 2% target. So we just posted that 3% number. Why this matters is because just last month, the Fed and Jerome Powell went ahead and said, hey, we might have to raise 2 more times in 2023 so we can get CPI where we need it. And when they said this caused a little pullback in the market because we're already at really high rates, 5% rates. If we move to 5.25 or 5.5, that's just going to put more downward pressure on the stock market and on the real estate market. But with that 3% number that we just posted, it's going to get way more difficult. If that CPI keeps coming down a little bit by a time each month, it's going to get really hard for the Fed to be able to justify raising rates even more. When we have a Fed funds rate that's much higher than the CPI percentage increase, it gets a little bit hard for people to get behind you continuing to raise rates and put the economy in a weaker spot. If they want to cool the economy off, they've cooled it off. CPI is coming down. The 3% number doesn't mean that things are getting cheaper. It just means things are getting expensive at a slightly slower rate. So I'd say they've definitely been able to cool the economy off by raising those rates. And that's evidenced by the fact that this is the lowest CPI print we've had in over 2 years. So what I think is going to happen, if the Fed does go ahead and raise rates, it is going to put some downward pressure on the markets. But I think investors are going to call Jerome Powell and the Fed's bluff because they don't believe that we need to raise rates much further because they've seen progress with the CPI month in and month out. But what I think is more of a possibility right now is that the Fed actually pauses again in July and they put themselves in a wait and see situation. Wait and see if CPI is going to drop to their 2% target. If CPI drops to that 2% target, I think they'll maintain rates there for a little bit. And then I actually see a rate cut coming in 2024 or potentially late 2023, but I seriously doubt it. Probably 2024 is going to be that rate cut. If we see a rate cut, sometimes that can lead to big downside in the market. But I think that correlation's a little flawed because typically when the Fed needs to cut rates, it's because they're trying to heat up the economy and the economy's in a really bad spot. That's why they're cutting rates. So I don't think we're in that situation. I think the Fed is making a mistake by keeping rates so high, and I think they made a mistake by even pulling them as high as they did in the first place, to be honest. So the reason they're going to have to cut rates eventually is not because the economy needs to be warmed up. It's going to be because they've hit their goal and they now want to bring rates to a little bit more of a reasonable spot, maybe a 2.5, 3.5, something like that. And as a result of that, I see big upside in the market over the next 6 months because I think the Fed is just going to be at a spot where they have their hands tied. All they can really do right now is wait and see, okay? Which means they're probably not going to be raising rates and they're probably not going to be dropping rates. But if they do raise rates, I think the market's going to brush it off and we're going to roar higher anyway. So based on all this, what's the best way to prepare yourself to make sure you capitalize from this? As always, the number one rule with investing, it's no different in this situation. You got to have more income than expenses so you can go ahead and flood money into your accounts. Because maybe I'm wrong and maybe the Fed raises rates a lot more, or worst case, we see CPI jump in the next few months and then Fed definitely has to raise rates after that. We would see some big pain in the market in that situation. So if you don't have money flooding into your account from your income on a regular basis, you're not going to be able to take advantage of deals. On that thought as well, let's not be 100% invested right now. I don't think it's a good idea to stay totally on the sideline, but I also don't think it's a good idea to stay 100% invested. Keep somewhere around 10 to 20% cash around in your account if possible. Some cash is better than no cash, but a nice cash position makes sure that you're ready for any situation that might play out in the market. And then the other thing is that as rates stay elevated at the 5+% range, and maybe the Fed raises, maybe they hold it where it is, maybe they cut, it's still going to be a pretty high Fed funds rate. What we need to make sure to do in the market is to invest in profitable companies. It's so important to invest in profitable companies as the massive core of your portfolio. To have a few speculative stocks that you put a little bit of money into that are unprofitable, that's okay, that makes sense, that is what it is, that's up to your risk appetite. But don't go out there and buy every single unprofitable company that has a great story behind it that might become the next big thing. As rates go up, capital becomes more expensive, especially if a company has to take out any debt. So a profitable company that can fund their business from operations and not from debt, definitely ideal. And then always look at the balance sheet of these companies. We don't want to be in debt-ridden companies, and we definitely don't want to be in high debt companies in high rate environment times. As rates go up, it becomes more and more expensive to service that debt, and then that means their margin is going to decrease more and more as rates go higher and higher. And they're just going to be in a weak spot for the entire time that rates are elevated. That's not something we want to see. So low debt companies, very well cash capitalized companies, and profitable companies so they can fund their business from their own income from operations. That is ideal. Keep the risky stocks to a minimum, keep the unprofitable stocks to a minimum. Doesn't mean you can't invest in them, but these are weird times that we're in. The Fed seems like they want to stay really hawkish. Hawkish means like they're aggressive. They want to keep on raising rates. Dovish means the opposite. If we start to hear a dovish Fed, more risk on is going to start to soar. If we hear a hawkish Fed, more risk on stocks are going to keep having a little bit of pressure on them. So choose your stocks wisely out there. Make sure you're looking at the income statement. Make sure you're looking at the balance sheet. Make sure you're looking at the cash flow statement before you ever buy any shares of a company. I want to know your take on this situation. Do you think the market's going to roar higher over the next 6 months? That's what I see coming, but I could totally be wrong. That's why I'm keeping cash on the sideline. Not a lot, but a little bit of cash on the sideline to make sure if we do have a big dip, I can take advantage of that dip. Let me know what you're doing out there. I want to hear about it. Thank you for stopping by and have a great day.